Travis, today we're going to talk about the newest CPI inflation report and why inflation is becoming a problem again, and why investors should pay attention to one major issue developing in the stock market right now, and that's just the whole idea of the market being extremely top heavy at this time. Mm-hmm. So let's start with inflation, though. The latest CPI just came out, and it was hotter than expected. It came in at about 3.8% year over year in April.
Yep.
A big part of that increase is due to energy prices, gasoline, transportation, and just the broader input costs of the economy as well.
Yeah, the Iran conflict isn't helping anything there, is it?
No,
when it comes to energy prices. But I'm having flashbacks,
it's not
Steve.
going away either.
No, I'm having flashbacks when we talked about inflation about every video, a few years back. And
23.
What was the word the Fed was using? Transitory?
Transitory,
That
that's
was transitory.
right. I forgot about that one.
So, but what's important with your inflation story here is this changes the narrative investors have gotten comfortable with. For most of last year, the market believed inflation was cooling, and it was coming down moderately, and the Fed would have room at this point to cut rates, and everything would keep moving smoothly higher, in markets. But now inflation is proving stickier than most expected, and we've said it for a while, but that last mile of inflation is really hard to wring out of the system. And now we have a flare-up thanks to energy. So
Exactly. And when inflation stays elevated, interest rates tend to stay higher longer, as you mentioned. That creates pressure on valuations, especially for stocks that have driven most of these market gains.
Yeah, and that's where, the conversation gets really interesting here, Steve, because, we'll have conversations with people and they're not even aware of that dynamic. So Correct. The stock market today is, incredibly concentrated. You've got 40% of the market valuation in 10 names, right? So a small group of those mega cap companies are carrying a massive percentage of the S&P's 500's not only weight, but performance year to date as well. So you look at an index, broadly diversified, things are great. It's only a few names doing the heavy lifting.
That's right, and it's so misleading because a lot of people are in these indexes and they think that they're diversified. But to your point, 10 stocks, 40% of the return. But in reality, their portfolio is so top heavy, and a handful of stocks just continue to outperform, which is great, but they're not diversified.
And that really works well, Steve, when markets and those companies just keep going up. But history demonstrates that things become dangerous when leadership narrows. And we've seen this before. The nifty 50 stocks in the 1970s. Go read the book Super Money, and that's a great book to walk you through that time frame. Tech stocks in the 2000s. We were there for that. That was a very interesting time when anything .com would just... Let's tag .com to the end of it, and it would skyrocket, right?
Oh, it would just
balloon. And then you had housing and financials in 08, which is, obviously the worst market we've seen in our career, right? So the story always feels unstoppable when everything is at the peak, but momentum cuts both ways, doesn't it?
That's right. And and why does it matter? It makes the environment especially interesting, is that inflation and higher rates can expose you to concentration risk. When money was cheap, investors were willing to pay almost anything for the price of growth. Mm-hmm. Now profitability, cash flow, and valuation suddenly matter more. Which they always should.
And they should matter, You should have something to compare against versus, 0% interest rates. But so if this top-heavy market and this market leadership starts to weaken, even slightly, you will see volatility increase quickly because money is concentrated in those same names. And again, we said it before, momentum works both ways, on the way up and when everyone's heading for the exits. And that's, a hidden risk in a top-heavy market that people probably just aren't thinking about every day.
No, it's market's been going up mostly, so that's why.
Right.
And it doesn't mean these mega caps, so Travis, are bad companies, does it? They're incredible companies and businesses. The question is simply whether investors are becoming overexposed to this small corner of the market, and they really are.
Yeah, if you're just in the standard cap-weighted index as you are. But if you take a step back and look at it, better opportunities, sometimes better opportunities, are outside of those obvious winners in those cap-weighted indexes. So in periods like this, take a step back, broader diversification. You're always going to like businesses with strong cash flow at reasonable valuations, and they can become much more important than simply owning what's already gone up in a cap-weighted index right now. It's something worth thinking about for sure.
Yeah, that's true. And the CPI report's just a reminder that inflation is still there, and just like we're poking at us. And energy prices still matter. The markets don't move in straight lines forever. At the end of the day, your portfolio allocation should match your financial plan, your goals, and the level of risk that you're really comfortable taking.
So if you're looking at your investments and realizing, hey, they may not line up with what I'm trying to accomplish, especially in a concentrated market, again, that's a conversation worth having with your advisor, or we'd be happy to have that conversation with you.
That's right. If you're not sure where your current allocation truly fits your plan or your risk tolerance, reach out to us. We'd be more than happy to sit down, go over everything, and make sure that it actually works for you.
Designed specifically for you.
That's exactly right. Thanks, Travis. It's been great. Look forward to it next week.
Look forward to it as well, Steve.
Yeah.